When you're looking for relative equal highs, here's your secret weapon for it, okay? How do you know it's a high probability relative equal high that's likely to get swept or traded through? How do you know that, ICT? What differentiates that from any other? Okay, it's this. If you have two swing highs, if the one to the left is slightly higher than the right, you have a very, very high probability that they're going to want to take it above there. Just like you see here. We have a high, and then the swing here happens to be just a little bit lower than that one. Here's what's going on. This is called priming, okay? Priming is where you continuously create, inspire, or manipulate the expectations of a large number of investors. And they think, oh, it's going to go through that high. But then there's a lot of folks that don't want to see it go there because they went short. So when the market goes up here and stops and turns down, what that does is it creates a sympathetic sigh. The shorts are relaxing. If the shorts are relaxing, what are they saying? They're saying that this is now what? Resistance. So anyone that takes a new short position, where are they going to think that the safest place to put their stop loss is going to be? Right above these highs. Why can we trust that they're likely to take that relative equal high out? Not that it will that session that you're trading, but it's high probability that this will be swept when the second or the one to the right, that swing high is lower than the one to the left. That frames these two as relatively equal. Okay. Same thing is occurring here. We have this high here, this high here, this one being slightly lower than that one. So when the market went up like this and we had this drop down, what that causes is a sympathetic sigh. What is that causing people? Anyone that went short here, they feel like, okay, that's scary because it almost went to that high where their stop loss would be if they're trying to go short in this area. See that?